What's up, guys? Good afternoon. Alvaro over here. I hope you guys are having a very nice day. Happy Thursday. Let me pull up the chat over here. Where is it at? Let me see. General stock. There you go. Okay. Hey, what's up, guys? Isaiah. Hey, man. Charlie, Audric. Wyatt, Tech Guy Services, Leslie Williams, hello guys, Brandon Lee, Jonathan. Great, man, it is great to see you guys around here. Let me introduce myself. My name is Alvaro. I am with the Bilingual Stock Market channel. I also belong to the Chris community, and today we are going to be talking about covered call, guys. I am a covered call trader since 2 years ago. I have a lot of experience doing it. I actually closed a trade with a covered call that I started yesterday. I am showing these trades on my YouTube channel, the Bilingual Stock Market channel. You guys know that I am running a YouTube channel. All of our videos are spoken in both languages, English and Spanish. So this is great. This is a great experience. There you go. My friend Mario is over there. What's up? Hey, Curtis, Hamed, Mrs. Vice, Isaiah. I already said hello to Isaiah. So this is going to be fun, guys. I am looking forward to telling you guys about my experience when it comes to selling covered calls. I have made a lot of money. I have left some money on the table. But mind you, when we follow certain rules, before selling a covered call, there is no way of losing money. You can leave money on the table, just like when we close a trade ahead of time and the stock keeps on going up, but you will never lose money. So this is a win-win strategy. I love it. And I want to tell you guys the basics about selling covered calls. And then I would like to develop the content according to the questions that you guys are going to be asking me. So without further ado, let's get right into it. Some more people are joining the chat. This is great, guys. I am very happy of having you guys around. Okay, so covered calls, guys. What is it about? Let me pull up here a trade that I closed today on Coinbase. So let me show you what happened over here. So check this out, guys. April 13, this was yesterday. Check out the way that I was able to make $90 in one single day without running any risks, because this is a risk-free trade, okay? So yesterday I sold the $150 call of Coinbase. I am a, let's say, shareholder of Coinbase. Let's just put it that way. I am a bull. I am a crypto bull. I love Coinbase, and I think that this stock is going to the moon. So I own a bunch of shares of Coinbase. You guys know that before selling a covered call, you need to own 100 shares of any stock. So yesterday, I sold the $150 call that expires in June. This is on June 17. And I was paid yesterday, guys. Check this out over here. I was paid $670. This was yesterday. So what do you know? The trading session opened. Coinbase dropped like a rock, and I ended up buying back the covered call that I sold yesterday, or the call option that I sold. And I paid $580. So I ended up making over here $90, guys, in one single day without running any risks whatsoever. So this is the beauty of selling covered calls. And we can sell call options or covered calls on winning and losing positions. I guess that a lot of you, myself included, we're dealing with unrealized losses over here, guys. This is not a secret. As of now, we are going through a very tough corrective phase of the markets. I am making money out of my winning positions. I am a long-term investor in Tesla. I have made a killing over there. My friend Mario knows about it. Hey, bro, there you go. What's up? Okay, Charlie, easy money. That's correct, Charlie. This is easy money. And Jonathan, we're live. Sandreka, there you go. Okay, Hamed. So this is easy money. And this is a trade that if we know what we are doing, and as I just told you guys, if we follow certain rules, nothing can go wrong, guys, basically. And I will show you how I have left money on the table taking these trades. So I am going to pull up here Paint, and please excuse me for my poor handwriting. So what do you know to sell? What do you need in order to sell a covered call? First of all, you need to own 100 shares of any stock. Okay, and I guess that if you guys are watching this live streaming, you guys already know the basics about options trading. So you guys know that the options have a multiplying factor of 100. That implies that I can sell one covered call per every 100 shares of any stock that I own. Okay, one call or one contract. Okay, when we sell a covered call, the money, the premium, okay, that is going to be paid is going to be credited to our accounts immediately. We can do whatever we want with that money. Buying a beer, going to the movies, buy the dip, in any other stock, whatever you guys want to do with that money. So ideally, we sell a covered call when we are expecting that stock to drop, okay? Because we are basically taking a gamble against a call option, okay? So I'm going to erase this over here. So if I sell a covered call, guys, this is something that you need to keep in mind, right? If I sell a covered call or a call option, it's the same thing, guys. Some people say that you're selling a covered call, but in practical terms, we are simply selling a call option. So if we sell a call option or a covered call, I am expecting the stock or the price of that stock, of the underlying stock, to drop. Okay, just like the situation that I just showed you in the case of Coinbase. I'm going to pull up here Coinbase once again. So what happens over here, guys? I sold a covered call. I was paid yesterday $670. Coinbase dropped today, and I bought back this call option today, and I paid a fewer amount of money relative to the money that I was paid yesterday. Okay, and I ended up making $90 over here. So this is, these are the most basic concepts about selling a covered call. Okay, Vidor says over here, my friend Mario, I envy you. I envy your covered calls on Tesla. You legit once told me it's like a part-time job. Yeah, let me show you this, guys. Because as I just told you, I am a long-term investor in Tesla. I own 100 shares. My average cost is $266, guys. I swear to God. I can show you actually my position in Tesla. Okay, I am kind of a weird trader, guys, because I am a trader. I love trading, but according to my criteria, I love long-term investment. Okay, so I own a bunch of long-term positions. So I am going to show you some examples about the money that I have been able to make with Tesla. So check this out, guys. Let me see over here. Okay, so February 22nd. Check out this trade, guys. I hope you guys can see this, this information clearly on your phones or laptops or on whatever device you're using to watch this live streaming. So February 22nd, guys, not a long ago, I sell one covered call of Tesla, the $1,250 call that expires in September, and I was paid that day, guys, February 22nd. Check this out. I was paid $12,365. Okay, and what do you know, guys? I sell this covered call, and the next day Tesla fell off a cliff, and I was able to buy back this covered call, paying $11,185. I would like to do the math over here using my calculator, so you guys can see the amount of money that I made in one single day, overnight. So check this out, guys. I was paid on February 22nd, $12,365. And the next day, I bought back this call paying $11,185. $1,180 made overnight without running any risks whatsoever. That's why boy, he's trading big money, says Isaiah. So check this out, guys. $1,180 overnight. overnight. Unbelievable. And I can keep on showing you these kind of trades, guys. So let me show you another one. Let me look for another trade. So let me see over here. Okay, what about this one? So this one sell. Okay, it was a rollover. Let me see, sell. Okay, so February 14. Okay, so February 14. Check this out, guys. I sell the $1,500 call that expires on January 19 of 2024. I was paid $14,180, and on February 18, 4 days out, guys, I bought back this call, paying $13,550. Let me pull up once again here the calculator. Let's do the math together. So I was paid, this was on February 14. Okay, I was paid $14,180, and I ended up closing this trade paying $13,550. $630 in a matter of only 4 days. And I can keep on showing you guys these kind of trades. So, in new, I'll have 1,000, so it's possible to do it with only 1,000. Ken asked, I am new, and all I have is 1,000. But what do you have, $1,000 or 1,000 shares? Remember, guys, that theta is in your favor as well with covered calls, says Charlie. The most important factor that you guys have to keep in mind when it comes to selling covered calls is the implied volatility, guys. Ideally, we should sell a covered call whenever the implied volatility is above 70%. That implies that the premium that we are being paid is high, is expensive, because we are selling something. So we want the premium that we are going to be paid to be high. Okay, so ideally, that's one of my golden rules, guys. When it comes to selling covered calls, I always check on the implied volatility. And if it is above 70%, let's do it. Let's go for it. And with some positions, when the implied volatility is below 50%, 40%, maybe that's not the best moment in order to sell a covered call. $1,000. Okay, you have $1,000, Ken. You can sell a covered call, but you're gonna have to pick a penny stock, because you need 100 shares of any stock before selling a covered call. So you're gonna have to pick a penny stock. So you can do it maybe with sundial growers. Let me show you over here, guys. Let me pull up sundial growers just to tell my friend Ken about it. So sundial growers, let me show you guys, because he only has $1,000, but you can still sell a covered call. Let me see. So if you own, I actually own, how many shares of sundial I own? Let me see. I have a position here, 1,000 shares of sundial growers. This is a speculative position for me, guys. But if I am going to buy 100 shares of, let me see how many shares. Can you? Let me see, 100. So you can, well, figure this, guys. I don't know, 500. Yeah. If you buy, say, 1,000 shares of sundial growers, or I don't know, 1,500 shares of sundial growers, you're gonna have to invest $793. I am going to set this example over here. So 1,500 shares of sundial growers. This you need to invest $793. I'm gonna review the order. So this is 1,500 shares of sundial growers. If you own 1,500 shares of sundial growers, then you can sell 15 covered calls. And sundial is trading at 50 cents. So let me pull up here, I don't know, January 20th of 2023. So check this out, guys. Per every single covered call, Ken could be paid $14, but he would be owning 1,500 shares, so he would be able to sell. Let me show you over here the math, guys. Okay, for $13, if you sell 15 contracts, you could be making $195, bro, with $1,000 or with $750. Okay, the amount of money that you need in order to purchase 1,500 shares of sundial growers. So if you sell a covered call that expires on January 20th of 2023, you could be making $195 with a strike price of $1, because now I am going to show you how to pick the right strike price before selling a covered call. So yes, you can sell a covered call with $1,000. Okay, Kapil Potter would like to understand what factors to consider when selling covered calls. Other day you said that when IV is more than 70%, it makes you sense to sell. What else? That's the most important aspect that I consider when it comes to the math before selling a covered call. There's a technical aspect that I also take into account, guys. Let me show you over here. The relative strength index, the RSI. I don't know if all of you guys are familiar with the RSI, but whenever the RSI, mostly on a major time frame, my favorite time frame is the 4-hour chart. So ideally, I would sell a covered call when the stock, of which I want to sell a covered call, is trading with its relative strength index, with its RSI way above 70 points. So you guys know that when the RSI of any stock is signaling 70 points or a higher level, that implies that that stock is overbought. So that implies that we are likely to see some sort of retracement anytime soon. And when any stock is below, or when the RSI of any stock is below 30 points, that implies that that stock is oversold and that we are likely to see some sort of bounce back up. So from a technical standpoint, or this is another matter that I always take a look at before selling a covered call. I want to sell, or my idea would be selling a covered call, as I just said, preferably when that stock is very overbought, because I am taking a gamble against the call option that I am selling. So I want to sell a covered call, and immediately after that, I want that stock to drop. So the call option that I sold loses value, and I can buy it back, paying, a lesser price relative to the price that I was paid in order to sell that covered call. So there is also, a technical analysis, a fact that I take into account before selling a covered call. I always use the relative strength index, the RSI, as you guys can see over here on the 4-hour chart. Okay, what else do I have over here? I see that now. This is now a game changer for me, as I have a few hundred shares of Tesla and Apple stock. Mrs. Vice says, is selling a covered call the same thing as shorting a stock? No, it isn't the same. No, you're shorting a call option, but you're not shorting the stock. You're not really shorting the stock. And something that is worth pointing out over here, guys, when we sell a covered call, we are not running any risk whatsoever because we have the collateral. The shares that we own act as a collateral, so we are not running any risk whatsoever. When we buy a put option, if the trade goes against us, because you guys know that when you buy a put option, you're basically shorting a stock. So if the trade goes against you, you lose money. When we short sell a stock the traditional way, so if we borrow, the shares from our broker, we sell it, or we sell the shares immediately, expecting the stock to drop to buy back the shares at a lower price. When we do that, we are running a risk, because if the stock starts to go up, the loss that we would be assuming might be infinite, correct? But when we short a call option, because we are selling a covered call, we are not running any risk because we own the shares. Okay, that's why we always need to have 100 shares of any stock. Now, I would like to do some math over here with Mrs. Vice. What's your average cost on Tesla and Apple? Because now I want to tell you guys a very critical and important factor when it comes to selling covered calls, okay? And I am going to pull up once again here my Paint stuff, and excuse me once again because of my horrible handwriting. Okay, there is a critical factor over here, guys, the strike price. And why? Okay, now we are gonna start talking about more interesting stuff. So, and this is the most important rule that you need to comply with before selling any covered call. The strike price always, no matter what, guys, listen up here. The strike price always has to be above your average cost. This is critical. Strike price above your average cost. And why? Well, because you guys should know above average price, okay? You guys know that early assignment rarely ever occurs when it comes to options trading, right? Average price, okay? But it can happen. So, if something goes wrong selling a covered call, let's say that the stock, we sell a covered call, we sell a call option, and the stock, goes on an absolute tear. So, if the price of the stock goes above the strike price, then the owner of that call option that we sold can exercise their right to buy 100 shares of that stock at the strike price, even before the expiration date. So this is something that you need to take into account, all right? So my most important golden rule when it comes to selling covered calls is always, no matter what, setting a strike price that is above my average price. So if the trade goes against me, and if I happen to be exercised, or if I am forced to sell my shares at expiration date or before expiration date because the call option is in the money, then I can exit that part of the trade making a profit. This is absolutely critical. Okay, here comes Mrs. Vice, Apple 172, Tesla 980. Okay, I'm gonna pull up Apple over here to show Mrs. Vice how to sell a call option of Apple. Okay, so listen up here, guys. Apple, let me pull up here Apple quickly. So you are holding the bag with Apple, $172. No worries. Great stock. So I am going to pull up here the options chain of Apple, and you have to keep something in mind over here, guys, that the premium that you're going to be paid depends on the expiration date and also depends on the strike price. Okay, the farther out the expiration date, then the higher the premium that you're going to be credited. So let me pull up here April 14. Let me see, let's say August 19. Okay, so Mrs. Vice has an average cost on Apple of $172. So we need to pick a strike price above $172. I don't know how many shares do you own of Apple. Let me see if Mrs. Vice tell me over here. So let's pick the $170 strike price. I'm going to scroll up over here so you guys can see. 100. I can actually reduce, let me reduce this, guys. Let me see. No, this. Okay. Let me see. I can make this smaller. It's gonna be better. Let me see. No. Oh, come on, man. OBS. Help me out here. Come on. Okay. No, I'm moving the wrong stuff. Sorry, guys. I just realized that my screen is too big. I would like to make it shorter. Let me see. No. Maybe I cannot move this while I am already streaming. That's fine. Well, sorry about that, guys. Okay. So, 200 shares of Apple. Check this out, Mrs. Vice. So, if you sell 2 call options that expire on August 19 with a strike price of $175, you are going to be paid. Let me show you. Okay, I'm going to hit here the option, continue. You're going to be able to sell 2 contracts. Remember, guys, that we can sell 1 contract per every 100 shares that we own. So 200 shares over here, 2 contracts. Okay, perfect. Okay, August 19, $175. You are going to be paid on Monday, if you happen to sell this covered call, $1,500. $1,500 right away. That is going to be your money. You can do with that money whatever you want to do. You can go to the movies, you can get some beers, or you can go party with your, with your significant one, right? $1,500. Okay, what can happen over here? Okay, with your significant other. Okay, what can happen over here? Let's say that Mrs. Vice sells this call option on Monday, and Apple falls off a cliff on Monday. Let's say that, it closed today's trading session at $165. Let's say that Apple drops down to $150. what is going to happen with the two call options that Mrs. Vice is going to sell on Monday? They are going to lose value. So Mrs. Vice is going to be able to buy back these two call options at a cheaper price relative to the price, or relative to the premium that she was paid when she sold these two call options. That's the, let's say that's the positive scenario. Let's say that Apple goes on an absolute tear from Monday and on. What could be happening over in that situation? Well, in that situation, let's say that Apple goes above 175 bucks. Let's say that the two calls that were sold are right away in the money. And let's say that whoever purchased those call options wants to exercise their right to buy 200 shares of Apple at $175, even before expiration, which is something that is very, but very unlikely to happen. And I will tell you guys in just a minute why. Well, if that were to happen, if the call happens to be exercised ahead of time, before the expiration date, then she's going to let me see, how can I say it? She's going to keep the full premium, the total premium, $1,500, and on top of that, Mrs. Vice has an average cost of $172, and she's going to be selling, her 200 shares at $175. So she's going to be making a total profit of $1,700, $1,500 because she sold two call options, and she was paid $1,500, and on top of that, she's going to be paid $175 if the call options happen to be exercised at expiration date or before expiration date, and she's going to be making over here $300 more bucks. So this would be this trade would deliver a total profit of $1,800 in a matter of how long? What are we talking about here? August. So that's May, June, July, 4 months. $1,800. And if Apple happens to drop, then Mrs. Vice can buy back the two call options that were sold, making a profit as well. So this is a win-win situation. And I want to ask you guys, do you guys see any caveat over here? Is there any way of losing money over here? Yes, it is. The only way that you guys can lose money selling a covered call is setting a strike price below your average cost. Because in that case, the covered calls that were sold can be exercised before expiration or at expiration. And if your strike price is below your average cost, you're going to be selling out of your shares, taking a loss. That's why, and this is something that I really need to emphasize, before selling a covered call, you need to always, regardless of whatever, you need to set a strike price above your average cost. So what about this trade, Mrs. Vice? $1,800. Worst case scenario in August 19. How about that, huh? Okay, let me see what else do I have over here. What are the questions, guys? Your guidance on SPY and QQQQ is golden. Brandon Lee says, thanks, buddy. Yeah, we are very active over there. The main trading chat, along with my buddy Vitor. Okay, great time to be alive, says Brandon. So, 200 shares of Apple. So now you guys know the most basic information about a covered call. Okay, what would be the worst case scenario, guys? If we do everything, the right way, if we sell a covered call with a strike price above our average cost, what would be the worst case scenario? Let me show you something that happened to me not long ago with Upstart. Okay, this is let's say the painful side of selling covered calls. Check this out. I am going to pull up here Upstart. Okay, and I want to do this math with you guys. Okay. Because I just told you, when we sell covered calls, we cannot lose money. We can leave money on the table. That can happen. I'm not going to argue that. But we cannot lose money. So Upstart. Check this out, guys. I'm going to show you the history of my trades with Upstart. So on July 13, unfortunately, I think I can move. Let me see. Can I move this over here so you can see it? I think I can do it. No. Sorry, guys. I cannot do anything with my screen over here, unfortunately. Can I? Let me see. No. Why not? Oh. I thought I can, but no, I can't. Well, whatever. Sorry about that. Okay. So Upstart, guys. On July 13, I purchased 100 shares at $125.77. That was last year. Okay? Listen up what happened over here. So I paid $12,576. Okay? I had 100 shares of Upstart. Okay, on July 26th, on August 2nd, I sold a covered call of Upstart with a strike price of $127. Okay, let me say this again. July 13, I purchased 100 shares of $125.77. I was selling covered calls and buying them back. And on August 2nd, I sell a covered call that expired on August 13 with a strike price of $127. Okay. All right, guys. So check this out. What price was Upstart trading at on August 8th? I think, right? Let me pull up here again. On August 13. Okay. Let me pull up here once again Upstart. So when you sell a covered call, guys, and the stock goes on an absolute tear, you run the risk of losing the full upside potential of that stock. So Upstart was trading by the expiration date of this call option, guys, at $156. Here you guys can see this red line, right? So when my covered call was exercised, Upstart was trading at $158. Let's just round it up. $158, guys, and my average cost on Upstart was $125. I had 100 shares. We can do the math over here. Okay? 158 minus, I want you guys to see this, 125 times 100. I ended up leaving on the table $3,300, guys, because my option expired in the money. And I mean, I don't have a crystal ball, right? I didn't know that Upstart was gonna go up to $400 and that afterwards it was going to fall off a cliff. But I just, in this case, since I wasn't interested in keeping my shares of Upstart, I was like, I mean, shit happens. Sorry for the bad word, guys. I made some bucks selling covered calls and buying them back. And at the end of the day, since the strike price that I set for the last covered call that I sold of Upstart was above my average cost, at the end of the day, I ended up exiting this position with a profit of something like $500 or $600. So I mean, I didn't feel bad. I didn't feel bad about it. But you guys can see how I gave up the upside potential of Upstart by selling the last covered call that I am showing you guys over here, right? So that's the only negative aspect of selling a covered call. There are options. If you want to keep your shares, you can carry out a rollover, but I can speak about this because of my own experience. Rollovers are usually very stressful. So as much as I can avoid carrying out a rollover, I am going to try to avoid that situation. But this is the only negative aspect of actually selling a covered call, because in theoretical terms, we are giving up the upside potential of a stock. But mind you, I didn't lose any money. I exited this position making money regardless of the fact that Upstart, went up to the moon after I sold the last covered call, okay? Okay. So if the covered call expires in the money, That's when they exercise them, right? Yeah, correct. Exactly. Okay, early assignment, guys. This is a question that I get very often. Early assignment is very unlikely when it comes to options trading. I am going to pull up here once again my paint. And excuse me once again because of my handwriting. Okay, and these are two concepts that you guys need to get familiar with, okay? The first one, intrinsic value, guys, okay? And this applies obviously for every single option, call options, put options. And we also have extrinsic value, okay? So the intrinsic value, the intrinsic value of an option, okay, is the total value of an option at the expiration date. Okay, this is the value of an option, okay, when it expires, okay? When it expires. Obviously, if an option expires out of the money, then by the expiration date, there is no extrinsic value, okay? However, we have the extrinsic value. The extrinsic value, guys, of an option is better known as the time value, okay? And when it comes to the extrinsic value, this has a price. So in let's say in practical terms, whenever an option is in the money, whoever owns that option, put option, call option, can exercise their right to either sell or buy shares at the strike price, correct? But it is extremely unlikely someone to give up the extrinsic value of an option before the expiration date. So this is a question that I think that this is the most common question that I get when it comes to cover calls. Yeah, but what happens? You guys know that I am running my own Patreon, and my guys freak out a lot. Alvaro, I sold a covered call, and the call option is immediately got immediately in the money. And I asked them, when is the call option expiring? In November. So don't worry, bro. Don't worry. That option has a lot of extrinsic value. No one is going to exercise that option ahead of time. I mean, it can happen. It can happen here and there, but the early assignment, guys, if you ask me, I have been, sorry guys, I have been taking trades with cover calls for more than 2 years. And I'm going, let me delete this here. Let me erase this here. Okay, I don't know how many trades have I taken with cover calls in 2 years. I don't know. Let's just put a number right here. I don't know, 1,300 trades. And I have been assigned before expiration 0. It has never ever happened to me, guys. So early assignment is not something that you need to be worried about. And obviously, if you, as I just told you, if you don't want to sell your shares, which is a situation that can happen, you can carry out a rollover, which is something that I can also explain to you guys. Okay, D'Angelo, ask over here. There it is, Curtis. Okay. I can't stay because I'm headed into the gym, green mode, but I had to show up for Chris Zane and all my bilingual brothers and sisters. There you go, D'Angelo. Thank you, bro. Awesome. Mrs. Vice says, sounds great. Thanks for the help. Are you gonna start selling cover calls then? Mrs. Vice, I hope you will. And you own shares of Tesla. I mean, when it comes to Tesla, you can make a lot of money over there. But a lot of money. Absolutely. So that might be a win-win for you, right? Isaiah, are you able to walk us through step by step again, just for those who are late? Absolutely, yes. I'm still nervous though. You have nothing to lose. You don't have to be nervous at all. Let me show you what call option you can sell in the case of Tesla, Mrs. Vice. And I am going to tell the guys once again, Isaiah, no worries, absolutely. So let's see what call option, and if any of you guys wants me to estimate any cover call over here, I can do it. Absolutely, no problem. Let me show you over here. So this is my long-term position in Tesla, guys. As you guys can see, I own 105 shares. Average cost $263, guys. As of now, I have an unrealized gain of $75,000. Okay. Tesla. Let's see what is going on over here. Okay. So Mrs. Vice has an average cost of $980, I think, right? Let me see. Yeah, $980. And Tesla closed today's trading session at $984. So you need to sell a call option out of the money, preferably. So let me see. Let's pull up July. Let's do July 15. That's fine. So July 15. Check this out. So if you sell a covered call with a strike price of $1,050, okay, above your average cost, because your average cost is $980, you are going to be paid expiring on July 15. Listen up, Mrs. Vice, because we don't know. Today we had a very ugly close on the Nasdaq 100. Actually, the bulls gave up. I'm not really sure. Did the bulls give up 13,900 points? Mario, let me see. We had a very ugly close. Yeah, they give it up. So the Nasdaq 100 isn't looking any good, guys. I mean, I wouldn't be surprised. The next foreseeable support for the NDX, guys, is going to be 13,500 points. This is a previous area of support back from mid-March. So if the Nasdaq 100 happens to fill this gap down to 13,500 points, guess what is going to happen with Tesla? So this is something to think about. So since you own 100 shares of this stock, you should be selling a covered call. So if you sell this covered call expiring on July 15 with a strike price of $1,050, you are going to be paid on Monday $8,055. $8,000. So what would be the worst case scenario for you? That Tesla goes up on an absolute tear and goes up to $1,200, $1,300. If that were the case, you can actually carry out a rollover if you want to keep your shares. But what happens if the Nasdaq 100 collapses next week? Let's say that Tesla, and actually, what's the delta of this? Let me pull up here the delta. The delta 46. Figure that. Say that Tesla drops $200. You would be making over here in a matter of, I don't know, a week or a few days. You could make no problem, but no problem. You could be making $4,000. No problem, by the way. Yeah, by $7, correct. Yeah, we had an ugly close, very ugly close on the Nasdaq 100. Terrible close. So yeah, you know, the possibility of seeing another leg down, huge leg down, I would say down to 13,500 points, is on the table, guys. Absolutely. So if Mrs. Vice owns 100 shares of Tesla, I would be selling this covered call immediately, right away, like right away. Immediately. So you don't need to be nervous at all. No worries about that, okay? No worries, okay? So now you guys already know the downside of selling covered calls, because we can give up the upside potential of any stock. And now you guys know that you have absolutely nothing to lose. There's nothing to lose. This is a win-win strategy when we sell a covered call following certain rules, as I just told you. Always selling a covered call above with a strike price above our average cost. So if we happen to comply with, comply, or let's say obey or follow the rules that I just told you guys about, then there is no way that a trade such as selling a covered call can turn against us. This is a win-win situation. I have done it, as I just told you guys, for quite a long time, almost 2 years. And if you guys, and I know that that's a case of many of you, if you have losing positions, you can make some bucks while you wait for the stocks with which you have unrealized losses to go up. So you can, because as of now, I have showed you positions with which I am making money. But let me show you, because I have a losing position over here on Coinbase. So let me see. Okay, here. Okay, let me show you. In the case of Coinbase, this is a losing position for me, right? As of now, it's going to be a big win, right? I own 100 shares of Coinbase with an average cost of $186.93. And I have an unrealized loss over here. I am holding the bag, guys, of $3,952. But I am selling covered calls over here. So if my average cost is at around $184, what am I gonna do? This is a losing position. So I am going to do, let me see, I don't know, September 16, and this is a trade that I might be actually opening on Monday. I am going to pick a strike price above my average cost. But check this out, guys. Selling a covered call of Coinbase, let me pull this, let me scroll up here, with a strike price of $190 that expires on September 16. Check this out. Way above my average cost. I am going to be paid on Monday $1,250. So I have absolutely nothing to lose over here. If Coinbase happens to drop on Monday or keeps on dropping on Monday, I am going to be able to buy back this call option paying a lesser price relative to the price that I am going to be paid for selling this covered call. And if Coinbase happens to go on an absolute tear because I don't know, whatever, because Coinbase goes up to $70,000, and if I happen to be forced to sell out of my shares, I am going to be making another profit because my average cost is at $185 and I am going to be selling my shares at $190. This is obviously, guys, a win-win situation, no doubt about it. Okay. So I have Neon Balance here. There you go. 40% losses. Let's talk about that. Can you sell covered calls on UBXY and Triple Q? Yes, you can, obviously. The only thing that you need to sell covered calls is having shares. So let me pull up here quickly. Triple Q, the Nasdaq 100. My friend Vadir is an absolute expert when it comes to the Triple Q. He understands the Nasdaq 100 better than me. Truth be told. Okay, in the case of Triple Q, why do I need to sell like covered call? 100 shares. So first of all, I need to purchase 100 shares of Triple Q, and right after doing that, or right after having done that, I can start selling covered calls. Absolutely. Mrs. Vice, I'll watch a replay. Thanks again. Anytime, no worries. Okay. Kapil Powder, I have Neon Palantir with 40% losses. Learn from the best. Thanks, bro. Okay. I have Neon Palantir with plus 40% losses, and I don't want to get rid of these stocks. Okay, what's your average cost when it comes to these two positions? Okay, let's go ahead and take a look at the options that you can sell, bro. Absolutely, just let me know what's your average cost. Okay, and yeah, let's do the math to see how much money you can make selling covered calls, guys. For real, as of now, we are going through a very, let's say, very severe corrective phase in the markets. How long is it gonna last? We don't know. It might last long. We still need to see inflation coming down. We need to see a ceasefire in Ukraine. So as of now, we have a lot of fears on the table, and this can take a long time. This corrective phase of the market is going to come to an end. I am absolutely sure about that. But if you have losing positions, make money out of them. Okay? Don't stand with your arms crossed waiting for a miracle to occur so you can break even on those two positions. I just showed you how I can make money out of the losing position that I have as of now on Coinbase. So go ahead and do the same. Let's do the math here for our friend Kapil. Let's do it. Okay. Neo and Palantir. Okay. In the case of Neo, your average cost is 37 bucks. How many shares do you own? So I can do the math. Let's see, Neo. Okay, over here. Let's see. I am already selling covered calls on Uber. Good. But can't find any good strikes for Neo and Palantir. Maybe you can sell a leap. Could be an option. Maybe Neo 120. Okay, you have 120 shares. Okay, that's why. Palantir 155. Okay, I'm gonna tell you something else. Maybe this is something that you need to consider. Since both the stocks, Neo and Palantir, are as of now, on a clear downtrend, you shouldn't average down as of now, okay? Because you're going to be averaging down on downtrends, and that implies that if you buy more shares, maybe those stocks can keep on dropping, which is not which isn't obviously a good situation. I would advise to you selling put options in order to reduce your average cost, and by doing so, you're going to be paid a premium while you are trying to reduce your average cost. Because if you can have 200 shares of Palantir and NEO, then you're going to be able to make more money selling covered calls, and at the same time, you're going to be reducing your average cost. So that's an advice that I would be telling you. Okay, NEO. Certainly, you are at at $37. We're gonna have to look at a pretty far out call option. Let me see. January 20th of 2023. You are at 37. Let's see. It isn't much. Let's take a look at March 17 of 2023. 37. Yeah, your average cost. Yeah, this is an issue. I mean, you would be paid $150, bro, if you sell a covered call with a strike price of $40 that expires on March 17. It isn't much money. However, if you happen to own 200 shares, then you would be able to sell 2 covered calls, in which case we're looking at $300 of premium. And mind you, okay, NEO trades in the Nasdaq. What happens if we happen to see another leg down in the markets? So, what is the technical chart of NEO looking like as of now? Let's see. So did NEO broke the support today? Did NEO break the support? It is right at NEO is as of now right at a critical support, guys, $19.50. So what happens if NEO breaks $19.50 and if everything collapses, Nasdaq 100, Nasdaq, and so forth, then NEO could drop down to $17.67. So you also need to evaluate the technical chart of the stock. If you believe that there is downside coming up for the stock, you can sell a covered call even though the premium that you're going to be paid doesn't look like much. Because if you are being paid $150 by selling this covered call, but NEO actually happens to keep on dropping on Monday because, I don't know, all of the Chinese stocks are falling off a cliff or for whatever reason, then you could be making 50, I don't know, 60, 80, maybe $100, depending on the drop. So you start making money out of losing positions. That's that's the main message that I want to get across over here. So yeah, so you cannot make a killing selling covered calls of NEO and Palantir, but you can still make some money. You can still make some money over here. And in the case of Palantir, you're at 22. Yeah, that's a very high average cost. Let me pull up here Palantir Technologies. So what is going on over here? Let me see. $12. Yeah. Or maybe you can sell a leap, but in order to sell a leap, you guys know what a leap is, right? That's a call option that expires in more than 1 year, right? In the case, let's pull up March 17. Your average cost is at $22. Yeah, in the case of Palantir, you don't have much of a choice over here because your average cost is it is very elevated. So you could average down, as I just told you, selling a put option, which is the best strategy ever, guys. That's the best strategy ever in order to average down any losing position or any winning position, because we can actually average up a winning position by selling put options. I have also done it. And if you happen to have 200 shares instead of 100, then you're going to be able to make more money selling covered calls of both Palantir and NEO. Yeah, absolutely. So is the goal to hold it through the date and hope it does not hit the strike price? No. The hope, or that's what I do, whenever we sell a covered call, we just want the stock to fall, so we can buy back that call option paying a cheaper price relative to the price or relative to the premium that we were credited by selling that call option. I have been exercised, as I just showed you guys in the case of Upstart. but I have never held on purpose a covered call until expiration date. I have never done it. So I just play with the volatility as I did it yesterday with Coinbase. I also have over here a call option that I sold of Robinhood, guys, because I am hoping for Robinhood to burst above 12 bucks. I think that Robinhood is about to become a good trade. So yesterday, check this out, guys. Yesterday or on Tuesday, I purchased 300 shares of Robinhood at $11.96. By the way, I also opened this position because I took a deeper look at the fundamentals of Robinhood. This company has on its balance sheet a way larger, cash position relative to its long-term debt, which by the way is zero. So the ratio between the cash and cash equivalents of Robinhood relative to its market cap makes me believe that if this company, let's say, does its homework the right way, this could be a 20 buck or 25 buck stock, right? So I decided to purchase 300 shares. So since Robinhood has been failing systematically on, at trying to burst above 12 bucks, so I decided to sell to covered calls. And as of now, I have made 36 bucks over here. Okay? And this is a covered call that expires on May 27. So these 3 covered calls expire next month, and I am already making some money out of it. So if Robinhood happens to collapse next week, which is obviously a possibility, I am going to be able to buy back these 3 contracts, making, I don't know, maybe $100, $120, and then I can wait for Robinhood to pull up once again. And if Robinhood doesn't go above my average cost, then I can sell more covered calls on over very clear areas of resistances. So I am doing this, guys, left and right, and I am making good money on a constant basis by doing so. How long have you been holding that this position of Robinhood? You mean this is a position that I opened this week, I think. Let me see. Let me pull up the story. I opened this position. Let me see. April 12th. So I purchased these 300 shares on April 12th. Check this out, guys. And I would like to reconcile this information with the technical chart of Robinhood, guys, because this was my logic. So I purchased 300 shares of Robinhood at $11.96. Let me pull up here Robinhood quickly, guys. Okay, it's because everything happens for a reason. So check this out, the technical chart of Robinhood. What am I waiting for over here? And by the way, this is one of the stocks that I recently broke down from a technical standpoint in one of my videos. So 12 bucks for Robinhood is a critical spot in technical terms, guys. We have over here the 180 SMA on the 4-hour chart coinciding with a previous area of the 13 bucks over here. 12 bucks, sorry, correct, over here. 12 bucks. So 12 bucks is a previous area of support for Robinhood back from late March, and it is also a previous area of resistance back from late February. So I'm thinking that the second the bulls of Hood can take on 12 bucks on good volume and momentum, there is a huge gap. It will be filled up to 16 bucks or 15 bucks. So since this trade didn't work out the way that I was thinking, what did I do? And because I still believe that Hood has potential, so what did I do? I sold, as I just showed you guys, 3 cover calls, and as of now, I am making 30 bucks. And if Robinhood keeps on dropping, I am going to be able to buy back these 3 call options, making more money while I wait for Robinhood to recover. Because as I just told you guys, I think that this company, believe it or not, has, I'm not going to say solid fundamentals, but it has interesting fundamentals. Let's just put it that way, right? So why should I not place a covered call on all of my stocks that are not long term? There's no reason for that. You can sell covered calls on every single one of your positions unless you believe that a specific position is about to break out. All right. If Hood, for instance, guys, as of now, I have a gain over here of 36 bucks. If Hood on Monday happens to recover and starts to test this resistance at around $12, and I am breaking even on the covered calls, and if I believe that this resistance can be taken out, I am going to buy back the covered calls that I sold, expecting for Hood to make a push higher. I don't know, maybe to $14, $15. So obviously, this is something that we need to manage, in real time, depending on what is going on with a stock. Okay, but I am doing this as I am telling you, like left and right every single day, and I am making very good money. And this is the main message that I want to get across here, guys. We can make regular money without running any risks whatsoever. Zero risk. Okay? Zero risk. This doesn't imply either that I am going to buy a very overbought stock at, I don't know, $200, and I am going to prevent myself from placing a stop loss, because no, if the stock happens to fall, I can sell a covered call. No, that's not the idea. Okay, the idea is obviously trying to take winning trades, okay, based on TA. But if we like a stock, and if we don't want to take a loss because we believe that stock still has upside potential because we like the company, then selling covered calls is a way of avoiding placing a stop loss. Again, on stocks that we believe that have good fundamentals and that from a technical standpoint look acceptable, at least. Okay, and mind you, this week I had to apply a lot of stop losses. I am not selling. Selling covered calls is not a reason to avoid placing stop losses. This is something that I want to highlight over here. Okay. Okay, guys. So, if you guys have any questions over here, something that you want me to clarify for you, we are an hour in over here. It's been a very, let me double check that. Yeah, an hour. It's been a very nice chat, guys. An hour and 2 minutes. I like explaining this kind of stuff. I also want to explain to you guys how to sell put options. I have a lot. Maybe in another live streaming, we can go over fundamental analysis, which is something that I like a lot. Going over income statements, balance sheets, cash flow statements. And I would also I would also like to show you guys how to evaluate any company from a financial standpoint. So we have a lot to talk about, guys. And if you have any questions, then I am always here to help. By the way, I have a channel on Chris Saint's Discord chat. And if you guys have any questions, please, feel free to reach out to me, and I will obviously letting you guys know about my opinions of the markets and stuff like that. If you find time next week, can you go over the fundamental side of markets? Absolutely, yeah, absolutely. I would love to do that. Absolutely, 100%. So, well, guys, this has been a 1 hour long streaming. Thank you very much for your attention, and let's keep on doing this. Okay, I love teaching this kind of stuff, and I would like to to be able to tell you guys about the tools that I use on a daily basis in order to make money out of this business, which is a phenomenal business. It's been a tough one lately since early January, but better times are about to come up. So, Curtis, thanks, buddy. Gracias, señor. Awesome. So, well, guys, so let's stay in touch. And this is going to be a long weekend, so enjoy. Bye. See you. Thank you very much for your support, guys. It was very nice doing this. Bye-bye.